We are back with Credit Card Insider Senior Analyst Nathan Grant and Michelle Shanks from Summit Credit Union. They're answering your questions about money and credit card debt and checking accounts and savings and much more. You can continue to text your questions. The number is there at the bottom of your screen. All right, Michelle, let's go back to those first-time home buyers. You said do your homework before you go out to look at houses to find out what you're qualified for. What does doing your homework actually entail?
Well, it could be quite a few things. Definitely one is to find out what you can afford. Looking at the housing market, seeing what neighborhoods you want to live in, the cost of the homes to see if there's any equity in the home that you're looking to purchase, doing those kinds of things, and also taking a look at your credit history and credit report, because depending on where you're planning to get your loan from, they may have a minimum regarding their credit scores that they're looking at or some other variant. So doing all of that, finding out what is required of you. They may want a year's worth of history for your employment or, with your W-2s or whatever it is. So just finding out exactly what it is that you're going to need in order to make that home purchase on the front end, so that you're not surprised or shocked, or if there's any fees involved in doing that mortgage. So getting all that information first.
And people can call and they can talk to someone at their bank. They can call to other banks and talk about that. And they should have that list of questions to be able to just kind of go down and ask each one of those and not be afraid to ask those questions.
Yes, definitely, definitely. Here at the credit union, we do offer what we call our credit score analysis. So we can actually sit down with you, go over your credit history, answer any of those questions. We always tell people the best questions are the ones that you thought of and you just didn't ask. So, we can kind of walk you through that process and answer any of those questions before you make that purchase.
All right, Nathan, this person is asking, this is a very common question that we get, I think, every time that you're on. It says, if you pay off a credit card and you don't want to use it anymore, what do you do with that credit card?
Yeah, so we touched on earlier that, your credit scores could actually go down if you close the credit card. So unless you are paying an annual fee to keep that card open, it's usually wise to keep it. You never know when you might need it as an emergency. And even though you don't want to use a credit card for purchases that you can't pay off before the due date, it's nice to have that. And if you're feeling tempted to spend on it, you can technically cut the card up and still keep the account open. And then, when the time comes, you could ask for another card again. So even if temptation is something you're worried about, it is usually in your best interest to keep that card open.
Mm-hmm. And just a follow-up, someone says, why does your APR go up if you're making payments on time? And that could just be part of your agreement that you had, that it was going to go up after a year or so. But if you think you have an APR that is too much, what do you do?
Yeah, usually your APR, that's determined when you apply for the card. So you could have had a promotional APR that, went a certain period of time, and then when it's done, it kicks into the regular APR. The other thing could be a penalty APR. So even if you had a set APR for your card, but then maybe you had some late payments and stuff, there might be a penalty APR that would raise it. Otherwise, it should, your good payment history and stuff, that percentage is the actual money amount is gonna go down as you're paying down your balances. So that just make sure you stay on top of that side of things, and you should be okay.
All right, this person is asking, does it cost money to switch mortgage companies for a lower rate?
Well, I'll go ahead and tackle that. That's a maybe. With refinancing, because that is what it is. If you're refinancing your mortgage, there may be cost involved. You may get in on special deals where there are no cost for, the balance transfer or something. You may want to get in on that if you see that is a viable option. But there's usually cost involved because of all of the work that has to go into doing that mortgage, whether it's, for appraisal or some other, things that they have to do in order to make sure that they secure that mortgage. So those are questions definitely that need to be asked of the financial institution that you're looking to switch your mortgage to.
Before we head to break, Nathan, how about this question? Is there a top debt consolidation program?
So, if anybody says you can pay us and we're going to take care of your debt, that is more of a myth than anything else. But what these organizations usually do to help you consolidate your debt is basically help you do things that technically you could do yourself. You can always do the research and pursue different ways of paying off your debt or consolidating your debt. There's a lot of options out there, and everybody's situations differ. So if you're a little overwhelmed, and especially with something like debt consolidation, where you might want to simplify your debt payoff, it might be within your best interest to contact a debt consolidation group. But technically, everything can be researched and tackled on your own. So it's really up to the individual.
All right, we're going to be talking about balance transfers and whether they'll work for you or not. That is part of debt consolidation. We're going to tackle that when we come back after the break.